Lesson 16, Part 2, discounted loans, is where you pay interest basically at the end. They don't give you your full balance of the loan, they give you a discounted amount and you pay the full balance at the end. So for instance, if you needed $10,000 and the bank charges a 50% discount, you would need to ask for $11,764.41 because all you're going to get out of that is $10,000. You simply take your desired funds and divide it by 1 minus the discount rate to determine how much your loan request is. So you would get the $10,000, but then 1 year later you would have to pay back $11,746.71. A revolving credit agreement is where if you're looking to go out and buy a business, for instance, you go to a bank and you say, look, I need to borrow $3 million. And they say, okay, fine, we will give you a commitment, all right, to this loan. And the bank is basically guaranteeing a loan or a line of credit, which legally obligates them to do that, to give them that loan. Right? Again, in terms of lending, the SBA, Small Business Administration, is a government agency that goes out and guarantees banks that if they lend to certain small businesses, they will guarantee 85% of the loan on up to $150,000 or 75% for even more than that. It's a good program. It costs the lender, the person who's borrowing the money, 2% though. So if you are borrowing up to $150,000, that's $3,000 up front that you have to pay to SBA to get approved. Okay. Trade credit, we talked about in other courses, I'm sure, where you lean on the creditor. You borrow basically to buy goods and then you don't pay them back for a while. Trade discounts are remember the 210 net 30 that we talked about in Accounting 101? That's basically what we're talking about there. So there are ways to get some additional financing through your creditors. You don't have to pay them right away, not in those 30 days. You can let it go further, and that's a form, if you will, of borrowing. Right? Commercial paper is issued by the most creditworthy corporations. They take short-term notes, and they need to maybe make payroll, for instance, and they don't have cash coming in. They have a receivable that's going to be paid to them any day or any month now. So they go out and they issue commercial paper, they get cash, and then they pay it back very shortly. Okay? Secured assets, asset-based lending, is simply collateralizing debt with assets that you have on hand. Okay? In terms of your accounts receivable, you can use your accounts receivable as security on a loan, pledge it. Or you can actually factor it or sell it. When you factor it, you can either do it by maturity factoring, which means that if I've got credit terms of 210 and 30, I'm going to collect on that pledge on the 30th day. Okay, when it's supposed to be due is when I collect on that note, or on that factoring. Or I could get advanced factoring where they're going to take more money, but they're going to give you the money right up front on your accounts receivable. They will have it recourse or non-recourse, which means that if they pay, then if it's recourse, then they have recourse against you. So that if they don't pay, they get their money back. If it's non-recourse, they're going to give you a large discount, but you have the money to keep. If they don't collect, that's their problem. Okay? We can talk about other items such as blanket inventory liens and trust receipts and warehouse receipts. Basically, a blanket inventory lien is a claim against inventory when it's all the same. Flat screen TVs, okay, they're all about the same. They just say, okay, you've got 10,000 of them. Here's a loan for $100,000 with using that blanket inventory as a lien against the property. A trust receipt is where you have a lien against specific assets, a specific train car or a specific building, okay? A trust receipt. A warehouse receipt is issued by a warehouse indicating that you have assets in this warehouse that are bonded and it's going to be in safekeeping until you completely pay for them. So somebody may give you a loan on a particular machine. You put a down payment on it. When you pay for the full machine, you're able to cart that machine out the door. And a field warehouse is where on your own premises you have a warehouse that houses your various goods that you can take assets out of when you need them. Okay? Again, small businesses using short-term financing or taking receivables short term and turning them into cash. Thank you very much.